Welcome, everyone. Welcome to our webinar regarding Affordable Care Act and how it affects your large business. My name is Lori Dubois, and I'm a tax principal here at KLR in our Providence office. And I'm here with Norman LeBlanc, who is a tax partner at KLR as well. Just to let everybody know, your phones are muted at this point, but if you have any questions, we're going to save time at the end to answer them. So please put the questions into the chat feature of the webinar, and we will get to them at the end of the webinar. If you would like to follow us on Twitter, and our hashtag for the webinar itself is located on your screen.
So it's down in the bottom right corner there.
Bottom right corner.
Okay.
Okay, so let's get started. There's a lot of information here, so we're going to get started with the agenda.
All right. So you can see in here, we're basically going to cover 4 or 5, really major points of this, and it's what's important to business owners. In the process, we'll answer a lot of the questions you probably have. A lot of the things have been bouncing around and keeping you up at night. What we would like to do to start is maybe cover some of the things that are the reasons that the provisions are in place, what Congress's intent was. It'll help you understand what you're hearing and seeing, and by understanding it, it'll go a long way into allowing you to kind of get your arms around what the impact of this is and why it's happening. All right, so can jump into what's coming down the pike here.
Okay, so employers really must move forward now with the planning. The more education you can get, the better. So you want to figure out how to comply with the requirements of the law and also adjust and refine your healthcare strategies at this point to comply with those changes, as well as to support your business needs and HR objectives. So some major concerns that employers have right now are still some uncertainties in the plan. There's, the states are still challenging the regulations, considerable delegation to the federal regulators under the Act. There's still potential legal challenges to the Act at this point, and some unknown cost increases in 2014 and beyond. So right now, education is the key, figuring out what you need to be doing now.
So keep in mind, this thing's big, it's complicated. There's a lot of uncertainty and a lot of discrepancies, and it's new to everybody. It's new to business owners, it's new to us, it's new to Congress, it's new to the court system. So as these challenges come up, there's a lot of uncharted territory that really needs to be figured out, and that's why there's been some delays already. A lot of these provisions were supposed to happen earlier this year, and they've been put off. There's transitional components of this that'll help, give you kind of a little bit of grace period to learn these things and get compliant. But the important thing is, remember, it's complicated and it's big, but that's true for everybody.
Okay, so the rationale behind the Affordable Care Act, the number one concern for small businesses has always been the cost of the health insurance, whereas the employees were mainly concerned about getting that affordable health care themselves. Small businesses, on average, are paying about 18% more in health insurance than big businesses are, and that's mainly because they've never had the buying power to be in a large pool of employees.
Yeah, so keep in mind, when we say small business, we mean businesses, of your size. In other words, you're not a Fortune 500 company with 25,000 employees, so you tend to be in a much different pool of insurance than somebody who has employees in all 50 states and they have them by the tens of thousands. So one of the goals here by Congress was to level the playing field a little bit and give businesses your size the opportunity to buy insurance on the same plane that a very large company is buying it.
So before the Affordable Care Act, small employers, some of the obstacles they were facing were the insurance companies. There were too few choices of insurance, higher premiums and unpredictable rate increases. They were, actually charging higher for groups of women, older workers, and those with chronic health concerns in most states. And the waiting periods or no coverage for individuals with pre-existing conditions. So the Affordable Care Act is basically trying to alleviate these problems for small business owners. So today, under the Affordable Care Act, this is for insurance companies. They really need to, they have limits now on the amount of administrative spending, and that's including, marketing spending, CEO salaries. Most insurers now must spend at least 80% of the consumer's premium dollars on actual medical care. In the past, that could have been as low as 60%. And they must disclose and justify proposed tax rate hikes of, rate hikes of 10% or more with the, the state's federal government may review. So when they do the 80% of consumers' premium dollars, if that isn't the case with the insured, what's going to happen, August 1st of every year, rebates would need to go back to the insured if they found out that the 80% was not enhanced.
Right. So what you probably don't know is since 2012, the insurance carriers have been monitored to make sure that they spend this 80% and they're not overcharging. They're putting it back into care, and this has been going on, quietly. But now it's going to come into the forefront because, as Lori had mentioned, they're going to have to start issuing refunds if they aren't spending that money in the proper places.
So starting in 2014, insurance companies cannot charge higher rates or deny coverage because of a chronic or pre-existing condition. They also cannot charge higher rates for women and face limits on additional premiums for older employees as well. The pool risk across small groups creating larger pools like big businesses will help alleviate some of the premium costs, or that's what's meant to do. And there will no longer be any annual dollar limits, those caps on benefits, or the ends the lifetime limits for insurance.
So keep in mind, these are in place because these things were going on. Certain people did have to pay extra premium because they had a certain ailment, or women would typically charge more because they need more care. So again, this whole thing is designed to level the playing field.
And they must offer, on the last one, just go back 1 second. The plans also must offer a core package of essential health benefits. And, there's 10 categories if you look up that for what needs to be covered. And it's anything from prenatal, ambulatory, emergency services, chronic disease, oral and vision care. So there's a new definition to what's going to be in that essential health benefits for the coverage.
Okay. So now what we're going to do is spend a few minutes figuring out, are you a large or small employer? Now, if you've got a bunch of employees, it's kind of a no-brainer. Yes, okay, I got more than 50, I'm a large employer. But we need to walk people through who maybe are on the cusp of being large or small, and it makes a huge difference in the requirements. But more importantly as well, if you have multiple businesses, you need to calculate how it affects the companies that you might have only 10 people working in one business, but 65 working in the other. So we're going to walk you through how to calculate this. And once you hit that magic threshold of 50, you become what's known as a large employer, which means you're going to have to meet all these requirements that we're going to talk about for the next 50 minutes or so, about affordability and minimum value and shared responsibilities and all this other stuff. So step one really is to determine which category you fit into. You're either large or you're small, but you need to figure that out for all your businesses that are commonly owned.
Okay, so step one, like Norman just mentioned, is the definition of employer, the ownership test. And so IRS tax code 414 is basically going to give you those definitions, but it's all based on common control. So employers with common owners or who are otherwise related are aggregated together to determine if they're going to meet this greater than, the 50 or more threshold. So the rules can get complicated, and like Norman said, if you have businesses with related members, they may be all aggregated together to determine if you are 50 or more full-time employees.
Right. So typically, just to give you some general rules, it's usually 5 or fewer owners, and they own at least 50% of the companies across the board. All right, and there is an 80% rule, but again, it's not something that we could do in this, to walk you through this, because it's too complex, because you have brother and sister companies, parent and child companies. The best thing to do is to make a matrix. But the idea is, if you have companies with 5 or fewer owners, and you own more than 50% or 50% or more of these companies, you're going to need to chart this stuff out.
Okay, so the next step is to put everything in buckets and look at the employee hours of service. So for a full-time employee, what they're considering full-time is going to be anybody that's working 130 hours of service per calendar month. So it's really equivalent to 30 hours a week on average in any given month. Part-time employees, again, the law isn't going to be requiring you to offer coverage for them, but you have to take a look at them in your workforce pool to determine if you're going to be 50 or more employees. So you must aggregate the hours of service to figure out applicable large employer status. And for part-time employees, you're only counting no more than 20 hours per person is going to be considered basically a full-time person. So that's really, like about 28 hours a week. Seasonal employees, there is a seasonal exemption. So if you exceed 50 full-time employees for fewer than 4 calendar months, you may qualify for the exemption. So, the seasonal employees, if it's only for less, 4 months or less during the year that you're over that threshold, you may be still considered a small employer. So you want to just know your workforce and start the calculations now.
Right. So the thing is, keep in mind, like seasonal means, the holiday rush. So like a retail store hires a whole bunch of people during the season, or a place that's on the beach may hire a whole bunch of people during the, the beach season. Those are the ones that are going to get special treatment. For the most part, if you are a manufacturer or, a fixed place that doesn't have that, you're not going to be able to say, let me bounce people in and out. It's just not going to work. It has to have a true seasonality to it. Also, as you can see, and we're going to walk through a chart in a minute that's going to help, give you a visual on this. But it's not like you can just load up with a bunch of part-time staff and say I'm under 50. The way the formula works, again, we'll walk you through that in a second, but you're not going to be able to, strategize on how to get around this.
So the measurement dates that we're looking at, you're going to be looking at the previous 12 months activity generally. So January through December, and it's a monthly calculation. For 2013, there is a transition release, meaning that to qualify for 2014, you can actually use anywhere between 6 to 12 consecutive months to determine your status. And that's only in 2014. Beyond that, you're going to be looking at the full January through December of the previous year. So bottom line is, even if you're not going to use a full year to do the determination, you're going to have to start, the latest you can start calculating is July 1st of 2013 to determine if you're going to be a large employer for 2014.
All right. And all these calcs, the thing to keep in mind, this is a year-over-year calculation. So every year you're going to have to redo this. So you may be a small employer this year and large next, or vice versa, and it's a monthly calc. So as Laurie had mentioned, for this one time you can use 6 months, but in the future you're going to use the entire prior year, the entire 12 months of the prior year, to determine if you're large or small. And each year stands alone. All right, so if you look at the chart here, this gives you the visual. You take your circle here with the the full-time employees, and those are your folks working 30 hours or more. Those you move aside. Those are full-time, they count for full-time. In our example, it's 26 people. Then we take all the part-time folks, and you add up all their hours, but again, never more than 120 for a single person, because we're going to divide by 120. So if you counted 150 for one person, you'd actually count it for more than one. So you cap it at 120, and what you do is you add up all their hours, divide by 120, and you figure out that that's the equivalent full-time. So in our example here, we got 26 legitimate full-time. We've got 47 equivalent full-time, adding up all our part-timers, i.e. we add them together, we get 73 full-time equivalent employees. Bingo, we're a large employer. Okay, so this chart is very handy. You can download these slides from our website. They're already posted there. So this would be a great tool to help you walk through it. Also, we have a graph here. This is what it would look like if you're doing it every month. Again, you're going to see you get your 12 months here. And again, if I toggle back to our example, we get 26 full-time. We can see that on line 1 of our chart. So that's 26. We see it flexes from month to month a little bit. It goes up to 31, 35, 38 people. And then we go down to our part-timers. We see in January we had 47. It goes up and down. We add up all the total, and at the end of the day, we divide the grand total by 12. We come up with what our equivalent full-timers are for the year. In our case, 86 here. As you know, for this 1 year, you could just use July to December. That's possible, but next year you're going to use the 12 months.
Okay, so when you do that calculation, if the amount of full-time employees is 50 or higher, you're going to be considered a large employer, and you're going to be subject to the employer mandate for insurance. There's going to be additional reporting requirements as well, which we're going to go over. And if you are less than 50, you're going to be considered a small employer, not subject to the employer mandate, but you will be subject to additional reporting requirements if you elect to actually give insurance to your employees or offer insurance to your employees.
Right. So the thing you remember, if you're large, you have to offer coverage. They don't have to accept it. The employees don't have to take the coverage, but you have to offer it, and it has to meet the guidelines that we're going to cover now. If you're a small employer, you don't even have to offer it. So that's the big difference. And tomorrow will be the webinar, also at 2 o'clock, on small employers.
Okay. So the employer mandate, what does that mean? So for the large employers, again, you must offer your full-time employees and their dependents minimum essential coverage or face potential penalties. So we're going to go into the definitions here. Okay, so what does it mean to actually offer the coverage? It means basically make available with effective opportunity to accept or decline coverage. So employees can opt out if they're already covered by a spouse's plan or another plan. They don't have to accept it, and you will not be subject to the penalty if they are not on your plan. Some additional COBRA employee non-payment of their premium changes. Now you have to allow a 30-day grace period rule. That's also in effect for 2012. Okay, so what is a dependent? So when we're looking at the definitions, that's going to be an employee's child who is under age 26. So you don't have to offer it to the employee's spouse, but you do have to offer it to the dependent children. And you are allowed to rely on the employee for the children's ages and identity. And there is transition relief in 2014 that you won't be penalized if you're not offering this coverage, but you need to be taking steps to comply with the law and cover dependents in 2015 to get that penalty transition relief.
Okay, so here's the big question of the day. What's minimum coverage? What this means is the plan needs to pay at least 60% of the, here it says allowed cost benefit, but that can also be worded as basically pay the value of the covered services. So in other words, the copay can't be more than 40%. So this has nothing to do with the payment of premium. This has to do with the benefit that the health carrier is going to pay out. So whether it's a deductible or a copay, the carrier, whether it's a Blue Cross or United Health, they have to pay at least 60% of the services covered by the plan. Right? If they don't, then it's not considered a proper plan. It doesn't have essential coverage. Right? So when you hear that term, that's what that means. Of course, element number 2 is it needs to be affordable. All right, and we'll walk you through what affordable means.
Okay, so for a plan to be affordable for full-time employees, the employee's premium cannot be more than 9.5% of their household income, and that can be modified adjusted gross income. It's going to be based on single-only coverage, so that's what you're looking at there. There are 3 safe harbors to figure out whether or not it's going to be affordable or not. Not every employer knows what their employee's household income is, so they give you these safe harbors. One is based on the W-2 safe harbor. So as long as you're charging less than 9.5% of Box 1 wages on the employee's W-2, then it would be an affordable plan. There's also a rate of pay safe harbor, and what they talk about there is if you charge, and you can look at it and do it either individually or you can do it for all employees. But if you're charging, if their premiums that they're paying is less than 9.5% of the lowest paid employee, then you know that your whole workforce is covered and you meet the affordability standard. There's also a federal poverty line safe harbor as well.
So to explain this, as an employer, you're never expected to pay 100% of the health insurance. The employees can still put in their share. You can still require that they pay some portion of the premium. But whatever they pay can't exceed 9.5% of their income. And as Lloyd mentioned, you're not going to know their household income, so they're going to let you look at their income only in relation to an individual plan. Even if they're on a family plan, you can look at the individual rate and say, okay, is the individual plan cost that I'm requiring them to pay more than 9.5% of their wages? All right, and if it's not, then that's considered affordable. All right, and you only have to meet one of these safe harbors. You don't have to meet all 3. Any one of them will get you out of the penalty.
Okay, so what's going to actually trigger this employer penalty? If you have any full-time employee using a federal subsidy to purchase coverage on the exchange, and that could be because your insurance was either unaffordable, below minimum value, or they were part of the 5% that is not required to offer coverage to. So those are the reasons that you're going to end up with an employer penalty, or some of the reasons. And we put the poverty level, family poverty level slide in there to show you what the 2013 poverty level is for single and also for a family of 4. And just to know as well, there's going to be an impact on states that would, not expanding Medicaid. So for the states that choose to, Medicaid is going to be expanded to cover people at the 133% federal poverty level. Most states in New England have already come on board, have already been out there to say that they will expand as well.
Right, and this is one of the reasons you may have seen on the news. The states are suing the government because they don't have the money for this. The federal government hasn't given them new funds to pay, but yet they're requiring to expand the Medicaid for low-income families. So it's a little bit of catch-22, and you're going to see a lot of court action just for these types of reasons.
So the employer penalties are going to fall into two buckets, and they're both under IRS Section 4980H, and there's A and B. So if the employer does not offer the minimum essential coverage, there's going to be a certain penalty. If the employer does offer the minimal essential coverage, but it's deemed to be unaffordable or not of minimum value, or 5% of the or part of the 5% that's not offered coverage, there's going to be an additional penalty on that.
So we can walk you through the penalties. Now, the government actually calls this a shared responsibility payment, not a penalty. But there's going to be a lot of important points here. All right. So if a company says, you know what, I don't like all this, I'm going to do nothing, and you're a large employer, then what happens is there'll be a shared responsibility payment, i.e. penalty, instituted by IRS that will charge $2,000 per full-time employee over 30 employees. So to give you an example, if you had exactly 50 employees, you minus 30, and then you would be charged $2,000 for the other 20, or $40,000. That would be basically in lieu of health insurance. Now, the important thing to keep in mind here is you don't have to offer health coverage to part-time employees. And part-time employees are defined as employees under 30 hours. So the magic number that you may have heard, people strategizing was 28 hours. So if you had a bunch of people working 28 hours, technically, although they are using the calculation to determine if you're a large employer, they're not in the calculation of this penalty because you don't have to offer them coverage. You only have to offer full-time employees the coverage. So some companies may choose to say, you know what, I'll pay that $40,000. It's cheaper than the health insurance. Again, that's the kind of thing you're going to have to work through with your broker and your premium and all that other stuff. Now, there's a different penalty, which is a $3,000 per employee penalty, but that one is only assessed on individuals who were offered coverage but went to an exchange or got a tax credit from the government, which they shouldn't have, and they end up with that type of subsidy. Then the government tries to assess this $3,000 penalty on you. Now, here's how it works in theory. If you're offering adequate insurance, it meets the minimal essential coverage, it's affordable, then when the employee goes to the exchange, and we'll explain what that is in a minute, if they go to an exchange or try to get a tax credit, in essence, it's fraudulent on them because they don't qualify. Because when they fill out the questionnaire, they would show that they are offered the proper coverage and it is affordable, and they've gone around the system where they're lying on the application. But if for some reason your plan doesn't qualify, it doesn't meet those standards that we explained a few minutes ago, then for every one individual you're going to pay a $3,000 penalty. But that's not on everybody. Unlike the $2,000 one that's on all full-timers, the $3,000 is only on people who went and got a credit or a subsidy. All right? And the $3,000 is broken down per month. So it's, if they only get coverage for 2 months of the year, you pay $250 a month, not $3,000 all or nothing. They cap it so that if a bunch of employees got, and again, meaning your plan wasn't qualified, and a bunch of them got subsidies, they do cap it so that you never pay more than if you had no coverage at all. So it's not like you can say, well, you know what, I'm not going to offer coverage because I might as well just go for the $2,000. It's cheaper. So they cap it so that you can't ever be hurt more than if you had no coverage at all. So again, the best defense here, the point I'm making is the best defense you have against these penalties is to offer the essential coverage that's affordable, make sure your employees know about it, and If they go and fraudulently get a credit, that's on them. But your defense is, make sure that you've got the pieces in place to be compliant.
Okay. So when do you have to decide this? Basically, the penalties are going to be effective starting January 1st, 2014, and there is some transition relief for fiscal year plans. But really, employers must know what they're going to do by October 1st, 2013, because there is requirements there to provide employees with the coverage options. They have to give notices to employees regarding what is going to be given to them. So there's a website there, the Department of Labor website, that shows you what those, the technical release and the model notices that you can give to employees. So they're there now. I mean, if you know at this point what you're going to do for going forward, you can, start giving the required documentation to your employees sooner rather than later. Right.
So keep in mind, as I mentioned, you're going to be thinking about this today because you have to notify employees before October 1st. And you've only got, if you think about it, you've only got 3 months to do that. Now, the reason it's important is there's 2 notices. You either give them a notice of, here's your health plan and what it means to you, or you give them a notice saying, we're not going to have a health plan, this is what it means to you. So you have to decide which health plan or none that you're going to choose. And again, that means get with your broker right away, be thinking about what you're going to do, model this stuff out, get some help to figure out what it means to, if you have multiple multiple businesses that have employees, what it means to get all that group together, and then you can make the right choices and issue the proper notices.
Okay, so in addition to those penalties, individuals now have a mandate to get insurance starting in 2014 as well. So if you as an individual are not offered health insurance from your employer plan, you have to go out on your own and get insured. So there are some limited exceptions, but basically all individuals must maintain that minimum essential coverage or pay a penalty individually on the individual tax return. So that coverage can come from government-provided coverage, employer-sponsored coverage, or through an exchange. So there are certain exemptions that, based on religious objection, American Indians, some of the things here are going to be exempt from the mandate. But also for uninsured for less than 3 months. So if you're in between jobs and you didn't have insurance for less than 3 months of the year, you would not be subject to that individual mandate and penalty. But otherwise, this is going to be something that will appear on the 2014 individual income tax returns, and it'll be another question that needs to be answered. And if you don't have the essential coverage and you don't meet the income requirements to not have it, then you will be subject to the penalty, which we'll show next.
Right. So the reason that we bring this up is, although this individual mandate doesn't affect you as an employer, it will affect your employees, and those employees are going to become very active as they learn about this stuff. First time that they themselves get a penalty, or they mess it up on their tax return, or they see it in the news, they read it, they're going to get extremely active, inquisitive. They're going to ask a bunch of questions. You don't want them creating, rumors, spreading gossip about what the company's doing. So the best thing you can do is get out in front of them. And as you can see here, they have a mandate of their own, and they are going to be steered in some direction, like it or not, and with that they're going to have a reaction, and you're going to feel that reaction as your employees liven up.
So the penalty right now for 2014, it's going to be a calculation on the higher of a flat dollar amount each year or percentage of income. So for 2014, it's going to be, the penalty is $95 per adult, $47.50 per child. And that's going to be, up to $285 for a family, or 1% of your household income. And as you can see, for 2015 and 16, those amounts are going to be increasing each year so that the penalties are a little steeper as we go. There is, just to point out too, there is an online calculator. The Kaiser Family Foundation has it. It's just kff.org that you can actually put in the information. It'll give you, you know, if you put in your income level, it'll tell you at this point whether or not you would qualify, even though the isn't final yet, but whether they expect you would qualify for a subsidy and whether there is any way that you would actually get out of this penalty, and it would calculate the penalty for you. So it's another good resource for you if you're plugging in numbers.
Right. And as you can see, that, you know, the penalty is going to escalate for you. And again, this is the employee penalty, not the employer, but your employees are going to feel this if they don't have some kind of coverage. So as the dollars go up, they're going to become more and more in tune with what they need to do, and again, they're going to react to it. All right. So as we mentioned, there is some notices you need to send out by October 1st. And we're giving you 2 links here to the Department of Labor sample notices. And if you get a chance to write this down, great. But even if you don't, again, these slides are on our website. It's conlitwin.com. You go to our website, you can download these slides, and these links are there. And they're also in our blogs. If you go to our website and look at our blogs, you can click on these links. These are 2 sample notices that contain the elements that are required. And the elements are, you have to let the employee know whether or not you're offering insurance. You have to let them know what the coverages are. You have to let them know what they need to do. So these notices cover those bases, and you can fine-tune them. They're only a sample, so you can fine-tune them to your company's needs and then roll them out. And again, you've only got 3 months to do this. As you see, there's one for insurance and one with no insurance.
Okay, so there's additional W-2 reporting requirements as well. And so for 2013, all employers are going to need to put the health care coverage costs on everybody's W-2, and that's going to go on box 12 with the code of DD. And again, like Norman just mentioned, October 1st, 2013, is going to be the deadline to provide those written notices to the employees about the insurance.
So for the W-2, just keep in mind a couple things. One, this is not a tax matter. It's strictly a disclosure. Congress's intent was to say, okay, employees, you need to know how much health coverage costs. And that's why in that box 12, you're going to put both the employer paid amount and the employee paid amounts. In other words, it's the total premium, regardless of who pays it. Does not have any change to the tax status, not going to make anybody pay more income tax or less. It's strictly a disclosure to let your employees know the total value of those premiums. And the thinking is then they can compare that to the new rollouts and how much they're going to be paying in 2014 and future, and then they can make good decisions about, you know, do I sign on, do I not? Those are, you know, the options that they'll have if they have the information.
Okay, so some new changes with the insurance as is. Beginning in 2014, the maximum waiting period you can give to employee coverage is going to be 90 days. And also starting in 2014, there's going to be additional incentives and rewards to provide workplace wellness programs. You know, so that the maximum reward increases by as much as 50% for smoking cessation programs. There's going to be new information reporting requirements for issuers of health insurance coverage. So that's going to be to apply to employers of any size that actually have self-insured health plans. The first report there would be due in 2014. I mean 15, sorry.
And the reason we mention this is you very likely need to amend and update your employee manuals, probably a Section 125 plan, but those should be reviewed now to make sure that for 2014 you're going to have the right wording. This way here, if any fingers point or if there's any lawsuits that arise, you don't get caught short with a conflict in your employee manual, your internal programs, and your Section 125 plan.
Okay, there's also many non-discrimination testing changes. So a group health plan cannot discriminate in favor of their highly compensated individuals. There's going to be a penalty for self-funded plans that, highly compensated individuals are, for tax-free benefits. For fully insured plans, also another penalty, which is going to be a fine per day per individual discriminated against. So there's going to be, many non-discriminatory changes. But at this point, it does not apply to grandfathered plans. So that's what that little asterisk is. And that's basically any policy purchased on or before March 23rd, 2010 that has not materially been modified. But you want to, be careful of that because the penalties here for the non-discrimination rules are quite high.
Right. So as we mentioned when we started, the whole idea, again, Congress's intent here was to level the playing field. And in the past, you could have, management only with coverage. Non-managers were not offered plans. That's changed now. It's very much now more like a 401k plan or a retirement benefit plan in that you can't pick and choose who can enroll. You're going to have to offer it across the board, and you're not going to be able to slant it or favor the upper tier of employees or owners. All right, so it's very much now, again, flattened out and much more like the other benefits like a 401k.
So some additional insurance reforms, the extension of coverage to children until age 26, which we talked about earlier. There's going to be this restrictions on annual and lifetime dollar limits of essential benefits. That's eliminated in 2014, so there can be no more restrictions on that. No pre-existing conditions can be excluded for children under 19. Group or individual coverage cannot be rescinded except in certain circumstances. Preventative services without cost sharing. This does not apply right now to grandfathered plans, but all other plans that have been modified since that March 23rd, 2010 date or new plans cannot have cost sharing for preventative services. The non-discrimination rules that we just went over in the previous slide. And there's going to be reports that will come out on the medical loss ratio.
Now, keep in mind that grandfathered plan, although it sounds funny, geez, I got a plan prior to September of 2010, but, there are plans out there that you just keep, changing the premium on. It's the same plan, but they quote you a new premium. Those are your grandfathered plans. Where employers are going to get outside this is when they stop bouncing around. And one year they're with one carrier, and then they switch to another carrier, and they go out to bid. You're going to end up with a new plan, and again, all these things kick in. And again, it's very much kind of a flatlining of the offerings that the carriers are working on now.
So some new fees that have also come out, in which you may be already seeing, Form 720. It's basically a part of that form. There's a lot of different taxes on that form, but there's a new patient-centered outcomes research fee, and that's going to be an annual tax of $1 for this year, multiplied by the average number of covered lives in your plan. It's generally going to be assessed on the health insurers themselves and sponsors of self-funded plans, and which would, likely pass down to the fully insured plans through your premiums. But what you have to be aware of, if you have a health reimbursement account, the employer is considered self-funded. So you may be getting notices now that say you have to file Form 720. The due date is July 31st of 2013 generally. And what it does is they're asking for, if you have an HRA, health reimbursement account, they want to know the average number of covered lives in the plan. So this would be the employee only. And, you know, you basically add them up, and it's $1 tax for each employee that you have under this HRA plan. So it's going to increment, and it's going to increase to $2 for next year, but there's a lot of these hidden little fees out there that you have to be aware of.
Now, to understand what this is you're most likely to have this if your company has a high deductible plan and the company's pooling money to pay that big deductible. So if your company has a plan offered today and it has a deductible, say for a single person, say $3,000, a family of $6,000, and the company's putting money aside to pay that big deductible on behalf of the employee, that typically is an HRA. All right? And if you have that kind of plan, you are going to have a 720 due this year if that plan was in place during the last quarter of 2012. All right? So if you have that situation, get a hold of the Form 720. You can reach out to us. You know, we have them. We can help you with this. It's a very simple form. You'll probably be shocked at how many different types of taxes are in this one form. But somewhere down around page 3 or 4, there is this line 133, which has this $1 fee right now per employee, going up to $2.
Okay, so in 2014 through 16, there's also going to be an exchange reinsurance fee. So it's going to be a 3-year fee, and it's going to be for health insurers and third-party administrators are going to contribute to this transition reinsurance program for the exchanges. And, you know, they're estimating over the 3 years that the contributions are going to be at around $25 billion. So it's right now it's set to be in 2014, $5.25 per month or $63 per year, and that's per person enrolled in a group plan. So, you know, employers may see this passed down from the insurer as part of the premium.
Right, so if you're wondering how Congress plans to pay for all this extra care, this is how. There's extra fees. Now, these fees aren't charged to you as an employer. They're charged to the insurance carriers. But we wanted to mention it to help you understand why the carriers, in theory, are supposed to be lowering the cost. Because the theory is you're going to have more people insured, a bigger pool. Therefore, with wider coverage, the cost should go down. However, offsetting this is extra fees. So there's a little bit of a discrepancy as to, you know, pushing the fee down and pushing the fee up, but you may see this passing through on the premium unless the carriers choose to absorb this, but that's not likely considering they already have the mandate of 80% of their expenditures being spent on coverage.
2014, there will also be a health insurance tax, and that again is going to be a tax on health insurers based on the net premiums written, again meeting higher costs for insurers down the road. So the initial assessment on this tax, and I don't think, you know, it's not finalized yet, but it's basically assessed that it could raise the cost of the employer-sponsored insurance by an additional 2 to 3%. And the Cadillac plan tax, this does not get into effect until 2018. But if you have a plan, this is going to be an excise tax imposed on premiums that exceed $10,200 for individuals or $27,500 for family plans. It would be a 40% excise tax on the actual excess of the value of the plan cost over those threshold amounts above.
Okay, so we're going to leave some time for questions, and what we'll do is if you want to type in your questions, we will read them out loud, and we will, you know, give you a response now. And we're not pressed for time, so if we go over the hour, that's fine. So if you have questions, feel free to type them into field there for texting, and again, we'll follow up on those.
Okay, and if you do want CPE credit, you can contact Steve Lafredo at slafredo@conlitwin.com and just let him know what session you attended, and he will get you the CPE certificate so that you can have that for your records. And I think there was, we have a couple of questions here.
Yeah, so one of the questions that came in was, what are we experiencing or seeing now with premiums being quoted? You know, they higher or lower than prior years. And what our experience has been to date is the carriers seem reluctant to quote. They're being very cautious because they don't know exactly what their cost is going to be. Because keep in mind, they need to cover pre-existing conditions. That's new for them. Prenatal care, that's new. They have to lower their premium so it's the same for everybody. They also have the 80% mandate to use that as coverage. So the bottom line is they're reluctant right now to quote a fee or quote premiums because they don't really know what their cost is going to be. If they're too low, they're in trouble. If they're too high, then they've got a government problem because they have to rebate the premiums. So right now they're treading lightly. They're dipping their toe in the water. The state exchanges, which is like a buying pool, has basically said, hey, carriers, we need you to start quoting, and they're not. The carriers are holding back to the last minute for all these reasons.
Okay, and a question came in on if the slides would be available, and yes, they will. They're going to be posted. The actual presentation itself is going to be posted to our website and the healthcare overview page at conlitwin.com, and we will post the PowerPoint slides there as well. There's going to also be additional content for the attendees on specific employer penalty, a couple of PDFs on that so you can have takeaways. Will also be posted to the healthcare overview page, and I think there was a couple other postings that we're going to have there as well. And I think a few more questions popping up.
Yeah. So one of the questions is, will the Cadillac tax amounts be adjusted by location? And keep in mind, this is a 2018 mandate, so it's a ways off yet. However, our understanding of the current law is it's the one fixed flat dollar amount. Now, this can change. As we mentioned, this thing is big, it's complex, not out of the question that it may, kind of evolve over time, but as of today, you're looking at those dollar amounts for states.
Okay, just trying to read through the questions now.
So one of the questions says, again, on the Cadillac tax, that some of the benefits could be deferred. So some of this could be a taxable fringe benefit. For the most part, our understanding, again, under current today law, is the taxable fringe benefit will be when people go outside of the employer-offered plans. They may not get a deduction for payments they make to an exchange, which is, again, the state-sponsored pool. So they might not get a deduction. In essence, it's taxable income to them, unlike now where you get a 125 plan and it's pre-tax. But our understanding is the Cadillac tax is an excise tax, 40% of the premium, which is pretty hefty. A $10,000 premium, that's $4,000. So it's not necessarily additional income, but 40% is every bit as severe as an income tax. All right. Another question is, I had a couple of clients send me notices from outside service companies to file Form 720. Should the provider inform them that they need to file, or is it the taxpayer's responsibility to determine the requirement? Very simple. Form 720 is the burdens on the taxpayer, i.e. employer, to determine if they are required to file. The instructions for Form 720, and we're happy to forward anybody that wants to send us an, if they send us an email, we'll be glad to forward you the instructions with highlights outlining exactly the requirements and what needs to be done there. So feel free to reach out to us for that, and we will get you that form and instructions, and we'd be glad to help you walk through it. Another question. Blue Cross has told someone that the renewal will reflect pricing based on individuals instead of families and employee and spouse. You know, this is new news to them. It's pretty much new news to us. They likely are offering premiums based on individuals to help you calculate if your plan's affordable. But our understanding is that there's still going to be family plans. There's still going to be employee and spouse plans. However, you're allowed to use the individual plan to determine if it's affordable or not.
Right, right.
Okay.
And then there's an additional question came in to please go over the 60% essential coverage by the insurance company again. And if you take a look at that, you know, the federal government has actually proposed 4 options to help employers determine whether their plan is going to meet the minimum value requirement. So there's you know, minimum value calculators out there. They you know, they're a little confusing. They're in Excel format, but if you know, they're out there on the web. But you know, the best bet there is to, and the recommendation is to contact your broker to determine if that, you know, that you have that 60% essential coverage. There's, you know, many different things that are now going to be included in that, which again, for, you know, prenatal care, things like that, you know, emergency room visits, things like that that now need to be covered to go into the calculation to determine if you have that 60% requirement.
Right. Now, again, the simple test there is look at the deductible and look at the co-pays. Again, you want to go a little deeper than that, but if you want to just give yourself a good ballpark idea, if you're close, look at the deductible, look at the co-pays, and if those aren't approaching 40% of the total coverage, then you're probably okay. But again, touch base with your carrier or your broker to confirm that, but that'll give you a good idea.
Okay. Anything else? The shared responsibility payment is not deductible by the employer. Is that correct?
So absolutely. You know, i.e. it's technically a penalty, and as you may know, penalties are not deductible, so you get no tax benefit. And again, this is part of that mix we were talking about, where you're going to figure out what's affordable and what's not, and you're going to figure out your cost. You got to remember, if you offer health insurance for the employer amount that you're paying, remember, you don't have to pay 100%. Employees can still pay some. They can still pay a pretty good chunk. The idea here is you can deduct the cost of those health premiums. If you say, I don't want to get insurance of any kind, I'll pay the $2,000. That's not deductible. So that's equivalent to, depending on your tax bracket, that $2,000 is equivalent probably to paying $3,000, maybe $3,500 of premium. So use that as a gauge. It's not 2 for 2, it's 2 for 3. So those we'll call it penalty are not deductible. All right.
Okay.
That's pretty much the questions. You know, you got a few seconds if you want to fire one in, but
otherwise, thank you for attending the webinar. We are going to be having a webinar at the same time tomorrow, 2 to 3, and it's going to go over the Affordable Care Act, how it affects small businesses. There we're going to go over the exchanges and you know, certain tax credits available to small employers.
all right. Thanks, everyone. Take care.
Thank you.